In 1968, the price of gold was $35 an ounce. That was the official number, the number printed in newspapers, the number quoted by governments. But behind closed doors, central banks were paying $42, then $44. Then they stopped quoting prices altogether. Within 3 years, the official price didn't exist anymore. Gold exploded to $850. That was a 2,300% revaluation. Not because gold changed, but because the lie finally broke. Now look at silver. The COMEX says $32, maybe $34. That's what you see on your screen. That's the official price. But there are reports from Shanghai, from Dubai, from refiners who actually deliver physical metal. And those reports tell a very different story. China is paying $89, not for paper, not for promises, for real silver delivered in hand. If the official price is real, why is the world's largest buyer paying nearly triple? What do they know that you don't? Every morning, millions of investors check the silver price. They see a number, $32, $34, maybe $36 on a good day. They believe that number is real. They believe it represents what silver is actually worth. It doesn't. The price you see is set on the COMEX, a futures exchange in New York where paper contracts trade back and forth thousands of times a day. But here's the problem. For every ounce of physical silver that actually exists in COMEX vaults, there are over 300 ounces worth of paper claims. Think about that. 300 claims. 1 ounce. This is not price discovery. This is a game of musical chairs. And most players don't realize the music is about to stop. The physical market and the paper market have become two completely different worlds. In one world, traders shuffle contracts and algorithms set prices in milliseconds. In the other world, refiners, industrials, and sovereign nations are scrambling to secure real metal. And they're paying whatever it takes. This has happened before. Between 1961 and 1968, Western central banks ran something called the London Gold Pool. The goal was simple: keep gold's price fixed at $35 no matter what. They sold real gold to suppress the price. They issued statements saying everything was fine. But behind the scenes, the price was already diverging. Private buyers were paying premiums. Demand was overwhelming supply. The gap between the official price and the real price grew wider every month. In March 1968, the London Gold Pool collapsed in a single weekend. The free market price immediately jumped 25%. And that was just the beginning. The pattern is identical. The instrument is different. And this time the divergence is even larger. In Shanghai, they don't trade paper promises. They trade metal. The Shanghai Gold Exchange operates on a fundamentally different principle than Western markets. When you buy silver in Shanghai, you take delivery. Real silver, real vaults, real weight in your hands. And when you actually want the metal, not a contract, not a derivative, not a promise, you discover something disturbing. The price is not $32. Reports from refiners, bullion dealers, and industrial sources have revealed a staggering gap. For immediate physical delivery of large quantities, Chinese buyers are paying $89 to $92 per ounce. Some reports suggest even higher for guaranteed purity and rapid settlement. Why would anyone pay nearly triple the spot price? Because they understand something Western investors don't. The spot price is a fiction. It's the price of paper. And paper is not silver. China has been accumulating silver at an extraordinary pace. Between 2020 and 2024, Chinese silver imports surged to record levels. Not just for jewelry, not just for investment, but for industry. Solar panels, electronics, electric vehicles, military applications. China is building the infrastructure of the future, and silver is irreplaceable. Here's what makes this alarming. China isn't complaining about the price. They're not demanding COMEX reform. They're not filing regulatory complaints. They're just buying, quietly, relentlessly, at whatever price the physical market demands. This is the behavior of a nation that knows the official price is temporary, a nation positioning itself for what comes next. When the London Gold Pool collapsed in 1968, the countries that had accumulated physical gold at suppressed prices became wealthier overnight. The countries that trusted the official price, that held paper claims instead of metal, watched their wealth evaporate. China has studied this history. They wrote research papers on it. Their central bank advisors have cited the London Gold Pool explicitly. They know exactly what they're doing. The question is, do you? Silver doesn't stay cheap by accident. It stays cheap by design. To understand why the price you see is fake, you need to understand the 5 mechanisms that keep it that way. Trigger 1. The Hunt brothers lesson. In 1980, Nelson and William Hunt tried to corner the silver market. They accumulated over 100 million ounces. Silver rocketed from $6 to nearly $50. Then the COMEX changed the rules mid-game. They banned new buy orders, allowing only liquidation. Silver collapsed. The Hunts were destroyed. And every large investor learned the real lesson. Try to squeeze silver, and the exchange will crush you. Trigger 2. the CFTC's 40-year delay. The Commodity Futures Trading Commission has debated position limits on silver for 4 decades. 4 decades of hearings, 4 decades of proposals, 4 decades of nothing. Exposed concentrated short positions remain untouched. The regulators don't regulate, they observe. Trigger. 3. JP Morgan's vault. In 2011, JP Morgan held massive short positions in silver, betting the price would fall. Today, that same bank holds the largest physical silver stockpile of any private institution on Earth. They went from shorting silver to hoarding it. What did they learn? What are they preparing for? Trigger 4. The ETF illusion. When you buy SLV, the largest silver ETF, you don't own silver. You own a share in a trust that claims to own silver. Read the prospectus. It explicitly states that shareholders have no right to redeem for physical metal. You own paper that references metal. That's not the same thing. Trigger 5. Central bank coordination. Silver must stay cheap because industry needs it cheap. Solar panels, semiconductors, military systems, all depend on affordable silver. Central banks have every incentive to suppress the price, not through conspiracy, through policy, through structured neglect, through looking the other way. 5 triggers, 5 interlocking mechanisms, all pointing in the same direction. The price is managed, and managed prices always break. Here's what makes silver different from gold. You can't fake demand. Gold sits in vaults, it gets admired, it gets inherited, but silver gets consumed, destroyed, used in ways that make recovery nearly impossible. Every solar panel requires silver, not a little, approximately 20 grams per panel. In 2023, the solar industry alone consumed over 140 million ounces. By 2030, projections suggest that number could exceed 250 million ounces annually, and that's just solar. Electric vehicles use silver in every electrical connection. Semiconductors require silver for conductivity. Military systems, missiles, radar, communications, depend on silver's unique properties, medical equipment, 5G infrastructure, water purification. The list never ends. Now, here's the math that should terrify you. Annual silver mine production is roughly 820 million ounces, but industrial demand is already consuming over 60% of that. Investment demand takes another chunk. Above-ground stockpiles, the silver sitting in vaults and warehouses, have been declining for years. We are drawing down inventories that took decades to build, and we're doing it while actively suppressing the price. This creates a collision course. At $32 silver, mining companies aren't investing in new production. Exploration budgets have been slashed. New mines take 10 to 15 years to develop. The supply pipeline is empty. Meanwhile, governments are mandating green energy transitions. More solar, more EVs. More electrification, policies that require billions of ounces of silver that don't exist at current prices. Something has to break. Either the green energy transition stalls or the silver price explodes to levels that incentivize production. There is no third option. China understands this. They're securing supply now at any price before the collision arrives. The countdown is already running. History doesn't repeat, but it echoes with disturbing precision. When empires rise, they accumulate. When empires fall, they've already been drained. And in the transition between the two, in that dangerous window when one power fades and another ascends, the flow of precious metals tells you everything. Spain learned this first. In the 16th century, Spanish galleons carried more silver from the Americas than the world had ever seen. But Spain didn't build with that silver. They spent it on wars, on luxuries, on maintaining an empire they could no longer afford. The silver flowed out to creditors in Genoa and Amsterdam. By the time Spain realized what had happened, the metal was gone, and so was their power. Britain understood the lesson better. Before World War I, the Bank of England accumulated gold obsessively. They knew war was coming. They knew gold would determine who survived. But 2 world wars drained those reserves. By 1945, the gold had crossed the Atlantic into America, and with it, global hegemony. The Soviet Union tried to reverse the pattern. Throughout the 1970s and 1980s, they secretly stockpiled gold and precious metals, hoping to build a war chest for economic survival. It wasn't enough. The empire collapsed anyway, but those who controlled the stockpiles became oligarchs overnight. Now watch China. For 15 years, China has been accumulating gold and silver at a pace that dwarfs all historical precedent. They're not announcing it. They're not boasting. They're simply buying through state-owned enterprises, through Hong Kong intermediaries, through direct deals with miners. This is the pattern of a rising empire preparing for a transition of power. The metal flows east. It has been flowing for years, and it won't flow back. Every rigged market follows the same trajectory. Every suppressed price meets the same fate. The only variable is time. Phase 1, denial. In this phase, officials insist the market is functioning normally. Prices are fair. Supply meets demand. Anyone who questions the system is dismissed as a conspiracy theorist or a speculator with an agenda. This is where Western silver markets lived for decades. The COMEX price was the price. End of discussion. Phase 2, divergence. Cracks appear. Physical premiums begin to separate from paper prices. Delivery times extend. Dealers run low on inventory. Those who actually need metal, industrials, refiners, sovereign buyers, start paying above spot. At first, the premiums are small, then they widen, then they become impossible to ignore. In March 2020, silver's paper price fell below $12. But try buying a physical coin that month. Dealers were charging $25 or more if they had any inventory at all. The divergence was visible to anyone paying attention. Today, that divergence has gone international. Shanghai pays $89, Dubai pays premiums. Refiners are quoting delivery delays measured in months. We are deep into phase 2. Phase 3, collapse. This is where the paper market loses all credibility. Buyers refuse to accept paper claims. They demand metal. And when the vaults can't deliver, the entire pricing mechanism fails. The London gold pool didn't gradually unwind. It collapsed in a weekend. One Friday, it existed. The following Monday, it didn't. Phase 3 arrives without warning. The divergence widens until it can't widen anymore. And then the snap happens overnight. We are not in phase 3 yet, but the distance between phase 2 and phase 3 is measured in confidence. And confidence, once lost, never returns gradually. One day, and that day is closer than most people think, the world will wake up to discover that the silver price they trusted was never real. It won't happen gradually, it never does. It will happen like the London gold pool, like the Soviet ruble, like every managed price in history that held until it didn't. One morning, the COMEX price will be $34. That evening, physical silver will be unobtainable at any price. And by the following week, the official number will be a relic, a reminder of a system that failed. The revaluation will be violent. Conservative estimates suggest silver's true clearing price, the price where physical supply actually meets physical demand, is somewhere between $150 and $300 per ounce. Some analysts argue higher. But even at the low end, we're talking about a 400% to 800% repricing event. Now ask yourself, who benefits? China benefits. They've been accumulating at suppressed prices for 15 years. Revaluation represents the largest wealth transfer from west to east since the fall of the British Empire. Every ounce they bought at $20 becomes worth $200. The math is straightforward. The consequences are staggering. Early accumulators benefit. The individuals and institutions who understood the divergence, who bought physical metal while paper prices stayed low, will see their purchasing power multiply overnight. But who loses? Western paper holders lose. Every SLV share, every futures contract, every COA silver market position that isn't backed by metal in your possession becomes a claim on a system that no longer functions. You'll own paper. The metal will be gone. Pension funds lose. They hold paper assets valued at paper prices. When the revaluation comes, they'll discover their diversified portfolios were diversified into different forms of the same lie. Industrial supply chains lose. Manufacturers who assumed $32 silver would last forever will face input costs that destroy their business models. Some will survive, many won't. This is not speculation. This is the mathematics of a system that cannot continue. Every empire that suppressed the price of money eventually faced the same reckoning. Spain, Britain, the Soviet Union. America's turn is coming. The silver flowing to Shanghai isn't coming back. The premiums aren't shrinking. The divergence isn't healing. And when the break finally comes, there will be two kinds of people. Those who understood what 89 silver meant and acted accordingly. And those who trusted the number on their screen until the screen went dark. The price is fake. The shortage is real. The transfer is already underway. The only question left is which side of history you'll be standing on when the world finally discovers what China already knows.